It's 11:47 p.m. on a Tuesday, and a 26-year-old named Ryan is sitting in his car in an empty parking lot, staring at his banking app. The balance reads $412. He just got paid 4 days ago. Rent is due in 11 days. And somewhere in the back of his mind, there's a number that feels less like a goal and more like a myth. $100,000. Not $100,000 in a house. Not $100,000 tied up in a 401k he can't touch for 30 years. $100,000 liquid, working for him, sitting in accounts he controls. Here's the strange part. Ryan isn't unusual. According to Federal Reserve survey data, the median transaction account balance for Americans under 35 sits somewhere around $5,000. Not $50,000. Not 20. 5. Which means for most people watching this right now, the first 100,000 doesn't feel like a milestone. It feels like a fantasy reserved for people who inherited money or got lucky with a stock. It isn't. And by the end of this video, you're going to understand exactly why the first 100,000 is the hardest money you will ever make in your life, and also why, once you cross it, everything after it moves faster than you think. Charlie Munger, Warren Buffett's longtime business partner, used to say that the first $100,000 is 8B asterisk 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 asterisk. He wasn't being crude for effect. He was making a mathematical point. Compounding needs mass to work. A 10% return on $10,000 is $1,000. A 10% return on $100,000 is $10,000. Same return, same effort, 10 times the outcome. The first 100,000 is where you build the engine. Everything after it is the engine doing the work for you. Let's actually walk through it. Not motivational nonsense. The real path, with real numbers, the way it plays out for an ordinary person earning an ordinary income in the United States today. Start with income, because income is the ceiling on everything else. The median individual income in the United States right now sits close to $52,000 a year before taxes. After federal tax, state tax, and FICA, a single person in a state with average tax burden takes home somewhere around $41,000 to $43,000. That's roughly $3,500 a month hitting a checking account. Out of that $3,500, rent or a mortgage payment eats the largest share. National average rent for a one-bedroom apartment is hovering around $1,400 a month, though obviously that number swings wildly depending on the city. Add utilities, groceries, a car payment or transit costs, insurance, and a phone bill, and a disciplined person is left with somewhere between $300 and $800 a month of genuine, spendable margin. That margin is the entire game, not the salary. The margin. Here's where most people get the math wrong. They think building wealth is about the size of the paycheck. It isn't. It's about the size of the gap between what comes in and what goes out, and what you do with that gap the moment it appears. Two people earning the exact same $52,000 can end up in completely different financial universes 10 years later, purely because one of them treated that gap as spending money and the other treated it as raw material. So step one, the unglamorous one nobody wants to hear. Before a single dollar goes into an investment account, you close the leaks, not by eliminating joy from your life. That approach fails almost every time because it's unsustainable, but by killing the invisible subscriptions, the food delivery habit that quietly costs $400 a month, the car that's nicer than your income justifies. A 2024 analysis of subscription spending found the average American underestimates their monthly subscription costs by roughly $200. $200 a month is $2,400 a year. Over 10 years, invested at a reasonable market return. That's the difference between retiring in your 50s and retiring in your 60s. Step two is where the first real money gets made, and it has almost nothing to do with investing. It's an emergency fund. Boring, unsexy, and statistically the single biggest determinant of whether someone stays on the wealth-building path or gets knocked off it. Here's why it matters so much. Roughly 37% of Americans say they could not cover an unexpected $400 expense without borrowing or selling something. When your car breaks down, or you lose a job, or a medical bill shows up, and you have no cushion, you go into debt. And debt at 18, 22, 28% interest doesn't just erase your progress. It actively works against you while you sleep, the exact opposite of what compounding is supposed to do for you. So the first real target isn't $100,000. It's 3 to 6 months of essential expenses sitting in a high-yield savings account. For someone spending $2,000 a month on essentials, that's somewhere between $8,000 and $17,000. It sounds like a detour. It's actually the foundation everything else is built on, because it means the next financial shock in your life gets absorbed instead of derailing you. Now here's the part where the real acceleration starts, and it happens in 3 parallel lanes, not one after another. Lane 1 is retirement accounts, specifically anything with an employer match. If a company offers to match 50 cents on the dollar up to 6% of a $52,000 salary, that's roughly $1,500 a year of completely free money, deposited the moment an employee contributes. Turning that down is functionally identical to a company offering a bonus and the employee saying no. Over a working career, unclaimed employer matches are estimated to cost American workers over $1,500 per person per year, on average, in free money simply left on the table. Lane 2 is a Roth IRA, and this is where most people building their first $100,000 should be putting serious attention because of one specific tax advantage. Money grows inside it completely tax-free, forever, as long as it's withdrawn in retirement. The contribution limit sits at $7,000 a year for people under 50. Someone maxing that out and investing it in a low-cost S&P 500 index fund, averaging the market's long-run historical return of roughly 10% annually before inflation, is looking at a very different trajectory than someone leaving that same money in a checking account earning close to nothing. Lane 3 is a standard taxable brokerage account for money that goes beyond retirement contribution limits or that someone wants access to before traditional retirement age. Let's actually run the numbers on what this looks like for Ryan, our 26-year-old with $412 in his account. Say Ryan gets serious. He tightens his spending, finds $400 a month of genuine margin, and commits it consistently. Retirement match first, then Roth IRA, then brokerage. $400 a month, invested consistently, earning an average annual return of 9%, which is slightly conservative relative to the market's long-term historical average. But to the end of year 1, Ryan has roughly $5,000. It feels agonizingly slow. This is the exact point where most people quit because the growth from returns is still tiny compared to the growth from Ryan's own contributions. In year 1, almost all of his balance is money he physically put in. By year 5, something starts to shift. His balance sits close to $30,000. Now, a meaningful chunk of that isn't money he deposited. It's money the market generated on his behalf, working while he slept, while he was at his job, while he wasn't thinking about it all. By year 11, at that same $400 monthly pace and 9% average return, Ryan crosses $100,000. 11 years. Let that sink in, because here's the twist that almost nobody explains properly. 11 years to the first 100,000 does not mean 22 years to the second 100,000. It means roughly 6 to 7 years to the second 100,000 at the exact same contribution rate, because now the balance itself is generating real annual returns. 9% of $100,000 is $9,000 a year, arriving whether Ryan adds another cent or not. The third 100,000 comes even faster. This is the entire secret hiding inside Munger's quote. The first 100,000 is brutal because you're doing all the work. After that, your money starts doing the work alongside you, and the curve stops looking like a straight line and starts looking like a hook bending upward. Now, 11 years is the baseline case, and for a lot of people watching this, 11 years feels like forever. So let's talk about the 3 levers that actually compress that timeline, because contribution amount is the only variable most people think to adjust, and it's not the most powerful one. The first lever is income growth, and it matters more than almost anything else in this entire video. Someone who negotiates a raise, changes jobs for a 15% pay bump, or builds a skill that moves them from a $50,000 role into a $70,000 role isn't just adding income. They're compounding their contribution rate on top of market compounding. Data from job-switching studies consistently shows that employees who change companies see wage growth roughly double that of employees who stay in place and wait for internal raises. If Ryan's income grows from $52,000 to $70,000 within 3 years, and he keeps his lifestyle roughly flat, his monthly investable margin doesn't creep up by $50. It can realistically jump by $400 or $500. Run that same 9% return math with $600 a month instead of $400, and the timeline to $100,000 drops from 11 years to under 8. The second lever is avoiding lifestyle inflation, which is the quiet killer of almost every promising financial trajectory. It's the raise that immediately becomes a nicer apartment, the bonus that becomes a new car payment. Studies on savings behavior consistently show that when income rises, spending rises to match it in the vast majority of households, often within a matter of months. The fix isn't complicated, even if it's hard to execute. When income goes up, savings rate goes up first, automatically, before the money ever reaches a checking account where it can be spent. People who automate a percentage-based contribution increase alongside every raise consistently outpace people who wait to figure out what to do with extra income, because money sitting in a checking account has a way of disappearing without ever feeling spent. The third lever is time in the market versus timing the market, and this is the one that trips up otherwise smart people. Missing just the 10 best trading days in the market over a 20-year period has been shown, across multiple long-run studies, to cut total returns by roughly half. The instinct to pull money out when markets drop, wait for things to calm down, and jump back in later feels rational in the moment and is statistically devastating over time because the best days in the market cluster right around the worst days. Someone contributing $400 a month into a boring diversified index fund every single month for 11 years, through corrections, through downturns, through headlines screaming that a crash is coming, dramatically outperforms someone trying to be clever about entry and exit points. Let's talk about what to actually invest that money in, because this is where a lot of people either freeze from overthinking or gamble from overconfidence. And both mistakes are expensive. For the vast majority of people building their first $100,000, a low-cost, broad market index fund tracking something like the S&P 500 or a total U.S. stock market index is the single most effective vehicle available. Not because it's exciting, it isn't, but because it owns a slice of roughly 500 of the largest, most profitable companies in the country, spreads risk across all of them, and charges expense ratios as low as 3 to 0.04% per year, compared to actively managed mutual funds that often charge 1% or more. Over a multi-decade span, that difference in fees alone has been shown in numerous studies to cost investors tens of thousands of dollars in lost compounding. Picking individual stocks, chasing volatile assets, or trying to time sector rotations might feel more engaging, and occasionally someone gets lucky and it works out. But the data on individual retail investors attempting to beat the broad market is consistent and unflattering. The majority underperform a simple index fund over long time horizons, largely due to emotional decision-making, excessive trading, and fees. The boring path is, mathematically, the winning path for almost everyone. There's one more piece of this that doesn't get talked about enough, and it's debt. Not all debt behaves the same way, and treating a 4% mortgage the same as a 24% credit card balance is a mistake that costs people years of progress. The math here is simple, even if it's uncomfortable. Any debt charging an interest rate higher than what you could reasonably expect to earn investing, call it 7 to 8% as a rough threshold, should generally get paid down aggressively before extra money goes into a brokerage account, because guaranteed avoidance of a 22% interest charge beats an uncertain 9% market return every single time. Debt below that threshold, like most mortgages and some auto loans, can often be paid down at the minimum while the difference gets invested instead, because the math favors the market over the long. Are you in.so? Here's the full sequence, laid out plainly. Build a starter emergency fund of about $1,000 first, so a flat tire doesn't send you into credit card debt. Attack any high-interest debt above roughly 7 to 8% as aggressively as possible. Build out the full 3 to 6 month emergency fund in a high-yield savings account. Capture every dollar of employer retirement match available because it's an immediate, guaranteed return that nothing in the market can match. Max out a Roth IRA if income allows, prioritizing broad, low-cost index funds. Push any remaining margin into a taxable brokerage account, invested the same way. And every time income rises, increase the savings rate before the lifestyle does. That sequence, run consistently, is what took Ryan from $412 in a parking lot to a six-figure net worth in his mid-30s. Not a lottery ticket, not a secret, not a crypto trade that happened to work out. $400 a month, an index fund, and 11 years of not quitting when the balance felt too small to matter. And that last part is the one worth sitting with. In year one, when the balance was $5,000, it would have been easy for Ryan to look at that number, compare it to the $100,000 goal, and decide the whole thing wasn't working. That's the exact moment almost everyone quits, right before the curve starts bending upward, right before compounding starts pulling its own weight. The first $100,000 isn't slow because the system is broken. It's slow because you're the one doing all the lifting in the beginning. Stay in long enough, and the money starts lifting for you.